Welcome, curious minds, to another deep dive. Today, we're plunging into a truly fascinating and increasingly relevant corner of the market. We're talking publicly traded companies that are making Bitcoin their primary treasury asset. Really interesting stuff. Specifically, we'll be dissecting two of the most prominent and maybe even audacious players, Japan's Metaplanet and the US-based MicroStrategy.
That's right. And, for those of you navigating the complexities of modern finance, maybe looking for exposure to Bitcoin through traditional equities, well, understanding the unique models these companies employ is absolutely crucial.
Definitely.
We're going to compare their distinct strategies, their sometimes quite innovative financial engineering, and fundamentally what it might mean for you, the investor, to hold their stock versus simply owning Bitcoin directly.
Exactly. Our mission today is to go beyond the headlines. We want to extract the most important nuggets of knowledge. We've got a stack of recent financial reports, some really insightful analyst notes, expert discussions.
Yeah, a lot to dig into.
We'll meticulously examine their business models, how they strategically accumulate Bitcoin, and critically, the strengths and weaknesses of their approaches across different market conditions.
Right, whether Bitcoin is booming, busting, or just kind of going sideways.
Yeah, that quiet sideways lull. We'll also highlight the key metrics you, as an investor, should probably be tracking to evaluate their health, and maybe explore some strategic considerations for, optimally holding these companies in your portfolio.
And look, before we dive in, a really important disclaimer here. This deep dive is designed purely for educational purposes. Okay. It is not, and it really should not be taken as financial advice.
Absolutely. Not financial advice.
Our goal is just to equip you with a deeper understanding of this landscape. We're not here to dictate what you should do with your hard-earned money.
Okay, got that covered. Let's truly unpack this then. We're kicking things off with Metaplanet, and honestly, their story, it sounds almost like fiction, the transformation they've gone through. For those who haven't followed their journey, can you maybe paint a picture of what Metaplanet was and what prompted such a radical pivot into Bitcoin?
It's quite the saga, really. Metaplanet was, for all intents and purposes, a distressed hotelier in Japan.
A hotel company.
Yeah, exactly. And their business was, well, as one report bluntly put it, wrecked. Events like COVID-19 just devastated them.
Ouch.
They were facing significant challenges, and a strategic pivot wasn't just an option. It really felt like a necessity for survival. So in April 2024, they made this profound decision, basically abandon their legacy business as the main focus and adopt Bitcoin as their core Treasury reserve asset.
Wow. So not gradual at all.
No, it wasn't a gradual shift. It was a full strategic transformation.
Yeah.
Driven by this desire to not just survive, but to, thrive in a completely new paradigm.
So it was a pivot born of necessity, it sounds like.
Okay.
But they seem to have executed it with almost aggressive ambition. What defines their core vision now? How are they measuring success in this new Bitcoin-centric world?
Their vision is refreshingly clear, actually, and it centers on one crucial metric they talk about all the time, BTC yield.
BTC yield, okay.
Right, and this isn't just about accumulating a massive total stack of Bitcoin, which, many companies might focus on. Instead, their ultimate goal, their key performance indicator, or KPI, is to grow their Bitcoin holdings per share.
Per share, that's the key difference.
That's the absolute key. What those numbers truly underscore for any investor looking at this space is Metaplanet's, frankly, ruthless efficiency in capital allocation. This isn't just about piling up Bitcoin. It's like a masterclass in shareholder-centric growth. Every move is designed to make your slice of the Bitcoin pie bigger.
Yep.
It's a pretty compelling blueprint for how a company can engineer per-share value, not just, total asset growth. And they've set this incredibly audacious long-term goal. They want to join the exclusive 1% club.
The 1% club, what does that mean in Bitcoin terms?
It means holding 210,000 Bitcoin by the end of 2027, which, to put that into perspective, would represent 1% of all Bitcoin that will ever be created, a truly monumental target.
Wow, that's ambitious is an understatement.
It is. But they also have aggressive shorter-term targets, which indicates they have a clear roadmap. They're aiming for 30,000 BTC by year-end 2025 and 100,000 BTC by year-end 2026. This explicit focus on accretive value for shareholders, growing that per-share number, is what truly differentiates them.
And their pace of accumulation since that pivot has been described as extraordinary. Can you walk us through the sheer scale of it? What's really striking about their growth?
It's genuinely astounding. As of mid-2025, let's see, June 26th specifically, Metaplanet held 12,345 BTC, acquired through purchases totaling about 156.4 billion yen. But the real story is the speed of their transformation. One of the sources we looked at described their pace of accumulation since that 2024 pivot as unmatched by any publicly listed company globally in its first year.
Unmatched globally.
That's what the report claimed. They managed to 63x their Bitcoin holdings. They surged from just 141 BTC a year prior to over 8,888 BTC by early June. And here's the critical part, the part that ties back to BTC yield.
Right, the per share aspect.
Exactly. They achieved this while only 3.33xing their fully diluted share count. That's a 233% increase in shares outstanding. The math on this is phenomenal. It translates to a staggering 19x increase in Bitcoin per share.
19 times more Bitcoin per share in about a year.
19 times. Think about that. Every share you hold represents 19 times more Bitcoin than it did a year ago, despite them issuing new shares. It's incredible efficiency. Their historical BTC yield performance backs this up. 41.7% in Q3 2024, an amazing 309.8% in Q4 2024, and then 95.6% in Q1 2025.
That Q4 number is huge.
It's massive. And what's even more impressive is that their Q1 2025 performance of actually 170% BTC yield significantly blew past their own ambitious 35% quarterly target. And for their fiscal year 2025, they've even raised their BTC yield target from 232%, get this, to over 600%.
600% BTC yield target.
Over 600%. It's not just accumulation, it's hyper-efficient per-share accretive accumulation. They are laser-focused on that metric.
Okay, that kind of growth, that kind of efficiency, it demands a unique financial approach. This brings us to their innovative financial engineering. It seems precisely tailored to exploit Japan's unique financial system. Can you elaborate on how they're managing to get capital at such seemingly good terms?
Indeed, their strategy is really a masterclass in leveraging specific market conditions. Japan has been operating with ultra-low, effectively zero interest rates for a very long time now.
Right, the famous ZRRP, zero interest rate policy.
Exactly. Metaplanet has capitalized on the structural advantage by issuing zero interest or zero coupon bonds. For example, they were able to borrow $30 billion, that's roughly $208 million at 0% interest. Zero.
Zero cost capital. That's almost unbelievable from a U.S. perspective.
It really is. This cost of capital is virtually unheard of in most major economies. It provides them with this profound structural advantage that's largely unavailable to, many international peers like MicroStrategy. It means they can acquire Bitcoin without that drag of significant interest payments. Nearly all the borrowed capital goes directly towards buying more Bitcoin.
That zero cost capital certainly sounds like an unbeatable advantage. But is there any hidden risk there? What happens if Japan's monetary policy does eventually shift, even subtly? Does that unravel their whole cost of capital edge?
That's a very astute question, and it's definitely a critical long-term consideration for Metaplanet. Yes, a shift towards higher interest rates in Japan would fundamentally alter their cost of capital. It would erode this key strategic advantage.
So that's a real risk.
It is. However, their strategy isn't solely reliant on those zero-coupon bonds. That's important. They've built a multifaceted approach. This includes their equity-raising mechanisms, which are designed to capitalize on share price strength. So while higher rates would certainly increase the cost of any future debt...
The existing zero-coupon bonds are locked in at zero.
Exactly. The challenge would be refinancing them or raising new debt in a higher rate environment down the line. This is why their other innovative financial tools, which we should probably talk about next, are so important for their long-term resilience. They provide alternative pathways for capital, even if that interest rate advantage diminishes somewhat.
Right. Speaking of other tools, this is where Metaplanet's financial wizardry seems to really shine. Their use of moving strike warrants. For those of us, myself included sometimes, who aren't deeply immersed in advanced finance, can you break down what makes these moving strike warrants so innovative? Why are they such a game changer for Metaplanet?
Absolutely. It's a really clever mechanism. So think of a typical stock warrant. It usually gives you the right to buy shares at a fixed price in the future.
Okay, like a call option, basically.
Sort of, yes. But a moving strike warrant is different. The price at which you can buy those new shares, the strike price, it moves dynamically. Usually, it adjusts with the company's current stock price.
Ah, okay, so it's not fixed.
It's not fixed. And this is brilliant because Metaplanet can issue these warrants and essentially skim capital off the top when their stock is performing well. When investor enthusiasm is high, they can typically issue new shares at a slight premium, say 1 or 2% above the current market price. This ensures they raise the maximum amount of capital with the least possible dilution to existing shareholders.
So they sell shares when people are most willing to pay up for them.
Precisely. It's a very capital-efficient way to fund growth, primarily when market sentiment is positive. Their $555 million plan, which involved issuing 555 million shares through these warrants, is potentially the largest fundraising of its kind in Japanese market history using this method. The genius lies in its flexibility. It allows them to issue equity precisely when their share price is strong, effectively leveraging investor enthusiasm to fund more Bitcoin buys cheaply.
So it's about raising capital almost on demand, and crucially, doing it when their stock is highly valued.
Yeah.
That sounds incredibly powerful for fueling that hypergrowth we talked about. What's the scale of capital they expect to raise through this, and how does it translate back into that accretive value, that BTC yield?
Right, connecting the dots here. This specific plan, the 555 million plan, aims to raise approximately $770 billion. That's around 5.3 billion US dollars over maybe 6 to 10 months.
$5.3 billion. That's massive.
It's huge. And the ability to sell into strength is absolutely critical for making it accretive. Let me give you a more concrete example to understand this accretive value idea using MNAV.
Okay, MNAV, market to net asset value. Remind us what that is again.
Right. It basically tells you how much the market is valuing the company's stock compared to the actual market value of its Bitcoin holdings after subtracting net liabilities. So it's the premium the market is paying. If their stock is trading at, say, a 10 MNAV, it means the market sees the stock as 10 times more valuable than the Bitcoin it directly holds, net of debt.
10 times premium. Wow.
Yeah, it can get quite high. And this high premium allows them to issue a relatively small number of new shares. Let's say they dilute existing shareholders by 10%, but raise a huge amount of capital because the share price is so high. They then use that cheap capital to buy so much more Bitcoin that they might effectively double their existing Bitcoin holdings.
I see. So the dilution is small relative to the amount of new Bitcoin they can buy.
Exactly. This creates an incredible return for existing shareholders, almost like a 90% yield on their Bitcoin per share in that hypothetical example, because they've acquired so much more Bitcoin without much relative cost in terms of share count increase. They even have a specific target accretion window for this. They aim to sell shares, use those warrants, when the MNAV is above 3. They project this helps them achieve 130% yield by the time they reach 30,000 BTC if they can maintain a 5 MNAV, compared to maybe only a 50% yield if they had to issue shares at a lower 2 MNAV.
So it shows a very sophisticated understanding of capital markets and a clear commitment to maximizing that BTC yield metric.
Absolutely. It's all about timing the market and leveraging their premium valuation.
So Metaplanet is clearly a master at acquiring Bitcoin, often with incredibly cheap capital. But it's not just about accumulation, is it? They've also found this unique way to monetize their existing Bitcoin holdings, even when prices are flat, through what they call their Bitcoin income generation program. How does that work? And why is it so crucial, especially when market conditions aren't ideal?
You've hit on a really innovative differentiator there. Yes, launched in Q4 2024, this program generates recurring revenue by actively monetizing Bitcoin's price volatility.
Monetizing volatility?
No, primarily through selling cash-secured Bitcoin put options. Imagine you're selling insurance. Metaplanet sells insurance against Bitcoin price drops to other market participants. In return, they collect premiums, upfront cash.
Okay, like selling insurance.
Exactly. If the price of Bitcoin falls below a certain point, the strike price of the option they commit to buying Bitcoin at that agreed upon potentially lower price, they've already got the cash set aside, hence cash secured.
Yeah.
If the price stays above the strike price when the option expires, they just keep the premium they collected. Free money, essentially.
Oh, okay. So they either get paid to wait or they get to buy Bitcoin at a price they were comfortable with anyway.
That's the idea. It's seen internally as a cash cow and a very low-friction income source because it requires minimal operating expenses compared to, say, running hotels. It's an incredibly smart way to generate operational cash flow that reduces their reliance on potentially dilutive financing, especially when the market isn't booming.
That is clever. Turning volatility, often seen as a negative, into a revenue stream. How significant has this program been for them financially so far? And what are their expectations going forward?
Good question. How significant is it? Well, in Q1 2025, this strategy produced $770 million, which is about $5.3 million US in income.
$5.3 million in a quarter. from selling options.
Yes, and that's not just a nice bonus. It accounted for a remarkable 88% of the company's total revenue for that quarter.
88%. Wow.
Yeah. This income stream provides crucial staying power, especially in sideways or even bear markets, by constantly earning money from volatility. It decouples their operational funding somewhat from just capital raises, and they expect this income to scale significantly as their Bitcoin holdings grow. For instance, that $5-6 million per quarter could potentially become, say, $30 million per quarter once they have 5 times their current Bitcoin stack.
That provides a real cushion then.
It absolutely does. This ability to generate consistent revenue from their Bitcoin treasury, independent of just raising new capital, gives them a unique layer of resilience.
Okay, that's a significant cushion. Let's also touch on Metaplanet's broader operational structure and their strategic position within the market. What else makes up their business, and how does their management team align with these complex strategies?
Right. While Bitcoin is undeniably their core focus now, they do retain a single hotel in Tokyo.
Still got one hotel.
Just one. This asset isn't a primary financial driver, but it is strategically important. They're actually rebranding it as the Bitcoin Hotel by Q1 2026.
The Bitcoin Hotel. Seriously?
Seriously. They envision it as a physical hub for the Bitcoin ecosystem in Japan. A tangible representation of their commitment, They also hold the exclusive license for Bitcoin Magazine Japan, which serves more as a strategic tool for marketing and education rather than a primary revenue source.
Okay, so strategic assets, but Bitcoin is the main game. What about the management? You need smart people to run these derivative strategies.
Absolutely, and their management team is a key strength here. It really cannot be overstated for executing these complex strategies. Simon Morris-Jarovich, their CEO, has a background from Harvard and Goldman Sachs with significant derivatives expertise. That's crucial.
Goldman Sachs derivatives background. Yeah, that helps.
It definitely helps. And Dylan LeClaire, their head of Bitcoin strategy, is well known in the space. He was formerly head of market research at Bitcoin Magazine, bringing deep Bitcoin market analysis. Their combined expertise in derivatives and Bitcoin market dynamics is absolutely crucial for successfully implementing these highly sophisticated accumulation and income-generating strategies. You need both skill sets.
Okay, that makes sense. Let's look at market performance. It's been pretty spectacular, right? And the liquidity.
Spectacular is one word for it. Looking at their market performance, their stock, ticker 350 on the Tokyo Exchange, was the best performing stock in Japan in 2024. It had a staggering 2,600% return.
2,600%.
Yep. And it continued into 2025, showing over a 1,480% one-year increase as of recent reports. What's fascinating here, and really important for their strategy, is its liquidity. It has become one of the top 3 most actively traded stocks by volume on the Tokyo Stock Exchange in 2025. We're talking average daily trading volumes in the tens of millions of dollars equivalent.
And that deep liquidity is key for those warrant exercises and institutional buying.
Absolutely critical. It facilitates large-scale institutional investment and makes their equity issuance much smoother. They also have a global reach now. There's an OTC listing in the U.S., ticker MTPLF, and even tokenized equity on StockR.io. CMTPL, which allows for 2047 trading using BTC, so they're broadening their accessibility.
Interesting. And shareholders.
Yeah.
Institutions.
Shareholder base has exploded. It expanded nearly 6-fold from around 10,800 in December 2023 to over 63,600 by March 2025. And they've attracted serious blue-chip institutional backing. Top holders include names like Capital Research and Management, Vanguard, VanEck, Invesco, even BlackRock.
Wow, the big players are in. Any analyst coverage?
Yes, Benchmark, a U.S. investment bank, initiated coverage with a buy rating and a JPY 2400 price target. They specifically highlighted Metaplanet's unique position as Japan's primary Bitcoin proxy.
Okay, incredible market performance, strong institutional backing. But beyond just raw returns and liquidity, there's another very practical, maybe even fundamental reason why this stock is so compelling, especially for Japanese investors. The tax situation, right?
Absolutely. This is a huge structural advantage for them in their home market. For Japanese investors, owning Metaplanet stock provides much more favorable tax treatment. Capital gains on the stock are typically taxed at 20.315%.
Okay, about 20%.
Right. This is a stark contrast to owning Bitcoin directly in Japan, which can be taxed as high as 55%. classified as miscellaneous income for Japanese residents.
55% versus 20%. That's a massive difference.
It's a game changer. It creates this powerful structural advantage, making the Metaplanet stock a highly compelling and tax-efficient vehicle for Bitcoin exposure within Japan. It fundamentally changes the risk-reward calculation for domestic investors there.
Okay, that's a deep dive into Metaplanet. Really fascinating strategy. Now let's shift our focus across the Pacific to MicroStrategy, the company that really pioneered this whole corporate Bitcoin treasury strategy, starting way back in August 2020. They remain the undisputed giant in terms of just absolute Bitcoin holdings. How does their scale compare, and what's the core business they maintain alongside Bitcoin?
That's right. MicroStrategy, MSTR, is the OG, the original gangster in this space. As of mid-2025, they hold over 597,000 BTC.
Almost 600,000 Bitcoin. Compared to Metaplanet's, what, 12,000?
Exactly. It significantly dwarfs Metaplanet's treasury. MicroStrategy is on a completely different order of magnitude, almost in a league of its own in terms of sheer holdings. And unlike Metaplanet's pivot from a distressed business, MicroStrategy maintains its legacy software business. They focus on business intelligence software.
Right, they still sell software.
They do. While its overall software revenue might be slightly declining, their cloud-based subscription services are actually showing strong growth, up 62% year over year in Q1 2025. This legacy business provides them with a baseline of operational cash flow and, importantly, established corporate infrastructure that Metaplanet, in its newer form, doesn't possess to the same extent.
Yeah, that's a crucial difference, having that established operational base, the history, the existing relationships.
Exactly. It's not just a revenue stream. It provides legitimacy, existing relationships, and a stable foundation for their very ambitious Bitcoin strategy.
And like Metaplanet, they have incredibly aggressive capital, raising targets for Bitcoin accumulation. What are those targets? And how does MicroStrategy, operating in the U.S. market without Japan's zero rates, approach financing? What's in their toolbox?
MicroStrategy's approach is, like a master chess player, but with a much larger, more complex board, perhaps. They don't have Japan's ultra-low interest rates, so they've built this broader, more sophisticated toolbox using U.S. capital market instruments. Their capital-raising targets are huge, a whopping $10 billion total targeted for 2025, split $5 billion equity, $5 billion fixed income, then $14 billion in 2026, $7 billion each, and $18 billion in 2027, $9 billion each.
Those are staggering numbers. How do they plan to raise that much?
Through a diverse array of instruments. They use convertible senior notes, for instance. These allow them to borrow money with interest, but the notes can convert into common stock later if the price goes up, so investors get potential upside.
Right, debt with an equity kicker.
Sort of, yeah. Then there are senior secured bonds. These are basically corporate loans backed by their efforts, typically offering lower interest rates because they're seen as less risky for the bondholder.
Okay, more traditional debt. And I know Michael Saylor has been a big proponent of a specific type of financing too, their perpetual preferred stock. Can you explain what those are? Why are they so central to MicroStrategy's strategy?
Absolutely. This is where it gets really interesting and shows their adaptability. They have this array of perpetual preferred stocks, tickers like STRK, STRF, STRD. Perpetual just means they don't have a fixed maturity date. They're designed to pay dividends indefinitely or until the company decides to redeem them.
Okay, so like a permanent layer of capital.
In a way, yes. Michael Saylor really sees these as ways to attract different types of investors, segmenting the market, basically. If you want a fixed income stream, maybe with some indirect Bitcoin exposure or downside protection, depending on the specific structure, you might go for one of these preferred stocks, whereas if you're all in on Bitcoin's volatility and upside, you buy the common stock, MSTR.
So different tools for different risk appetites.
Exactly. These preferred stocks offer varying yields and structures, appealing to different investor segments. Some might want Bitcoin performance with downside protection. Others just want fixed dividends. This diversified approach allows them to tap into different pools of capital, even in challenging market conditions, because they're offering something potentially attractive across the risk spectrum.
That's a very clever way to segment their investor base and diversify capital sources. And they also extensively use at-the-market equity offerings, or ATMs. How do those work, and what's Saylor's philosophy behind using them so much?
They do. They extensively leverage these ATM equity offerings. They have a massive $21 billion ATM program authorized. An ATM offering basically allows a company to sell newly issued shares directly into the open market at whatever the current market price is, rather than doing a single large underwritten offering. It's more flexible, more continuous.
Like dribbling out shares as needed.
Kind of, yeah. Saylor views Bitcoin as the absolute best use of proceeds for any capital raised through these ATMs. He emphasizes the transparency and the high-speed investment cycle these allow. He talks about deploying capital into Bitcoin within, say, 5 days versus the 5 years it might take for a traditional company to complete a major acquisition. This speed and efficiency are critical to their core strategy of continuous Bitcoin accumulation.
So their core philosophy, really championed by Michael Saylor, clearly emphasizes accumulating the largest absolute amount of Bitcoin possible, positioning them as the world's biggest public proxy for Bitcoin exposure. And while they also track BTC yield, that Bitcoin per share metric, the public narrative often focuses more on the sheer size of their total Bitcoin stack, right?
That's generally true. The narrative emphasizes the total holdings. But Saylor does state they aim for positive BTC yield. They want to be accretive. He's talked about structuring the business to deliver maybe 1.5x BTC or even 2x Bitcoin return for shareholders over time through the smart use of leverage and efficient capital raises. So while the headline number is the total BTC, they're demonstrating discipline in their capital raises, always with that goal of continuously acquiring Bitcoin while ensuring it adds value on a per-share basis.
Yeah. So from an investor's perspective, this leads us to a crucial comparison point. Holding direct Bitcoin versus opting for equity exposure through companies like Metaplanet or MicroStrategy. Let's start with the obvious, direct Bitcoin.
Right. Direct Bitcoin offers pure, unadulterated exposure to Bitcoin price movements. Simple as that. You own the asset directly, you bear its direct volatility, its upside and its downside. No company layer in between.
But equity exposure through Metaplanet or MicroStrategy introduces a completely different dynamic. As you mentioned, both offer leveraged exposure to Bitcoin. What does that mean in practice for an investor?
It means the potential for amplified gains in a bull market, because their strategies, if successful, allow them to acquire Bitcoin faster than their share count grows, especially when using debt or that premium valuation effectively. But, and this is a huge but, it also means potentially amplified losses in a bear market. If their stock premium compresses significantly, or if their debt becomes problematic, the stock could fall much harder than Bitcoin itself.
So higher potential reward comes with significantly higher and different types of risk.
Exactly. That's the trade-off. On the flip side, as you noted, these stocks provide regulated liquid exposure. They trade on major exchanges, and often they offer tax-advantaged exposure compared to direct Bitcoin ownership, which is especially relevant for those Japanese investors looking at Metaplanet.
And this brings up the concept you mentioned earlier, operational alpha. What exactly is that?
Right. Investing in the stock isn't just a bet on Bitcoin. It implies a belief in the management team's ability to execute. Can they successfully run their accumulation strategy? Can they generate income, like Metaplanet does with its options program? Can they manage capital efficiently, using debt and equity smartly? This is value created beyond just holding Bitcoin. That's the operational alpha the market might be paying for. And what's fascinating here, reflecting that perceived alpha, is that both companies consistently trade at a significant premium to their net asset value, or NAV.
Right, the NAV is basically the market value of their Bitcoin minus their net liabilities, the underlying asset value.
Correct. And they trade above that.
Now let's circle back to this crucial idea of premium to NAV. For anyone trying to wrap their head around it, what's the simplest way to think about what this premium truly represents in the market's eyes? Why does Metaplanet trade at, say, 5.12x its NAV in some reports? What does that tell us about how the market values not just their Bitcoin, but their whole strategy and management?
Think of it this way. NAV is like the basic ingredient cost, just the value of the Bitcoin they hold, net of their debts. Pretty straightforward. But the premium is like the market putting a fancy Michelin star on that meal. It's what investors are willing to pay above and beyond that raw Bitcoin value.
Because they expect something more.
Exactly. Because they believe in the management's ability, the unique strategies, the potential for future accretive growth, the liquidity, or maybe even those tax advantages we discussed. So Metaplanet's 5.12x premium means for every dollar of net Bitcoin value they hold, The market is valuing their stock at over $5. This high premium is justified, in the market's view, by factors like their rapid execution, that impressive Bitcoin per share growth, the deep liquidity on the Tokyo Stock Exchange, and its unique position as a tax-advantaged vehicle in Japan. It's a direct measure of speculative fervor, yes, but also investor confidence in their operational alpha, their ability to create value beyond just holding the underlying asset.
That makes perfect sense. It's the market betting on the skill of the chef, the strategy, not just the ingredients. MicroStrategy's premium is also substantial, though maybe not 5x usually, supported by its immense scale, its first-mover advantage, and Michael Saylor's powerful personal brand, which, interestingly, you mentioned even increases the stock's implied volatility, making their convertible debt offerings potentially more attractive to issue.
Right. Higher volatility can increase the value of the conversion option embedded in that debt. It's all interconnected. But this premium, while desirable for the company raising capital, also introduces a significant risk for the investor, doesn't it? What happens when that premium starts to compress?
Yeah, that seems like the big danger here.
It absolutely is. While a premium reflects investor confidence, an excessive or rapidly expanding premium, as one analyst warned, may signal a bubble. Premium compression is a significant risk. It can be devastating for investors who buy in at the peak premium. For example, MicroStrategy's premium compressed significantly in the past from maybe 3x NAV down to around 1.4 by 1.5x. That move effectively crushed investors who bought at the high premium, even if Bitcoin itself didn't decline nearly as much during that specific period.
So you could lose money even if the company successfully adds more Bitcoin.
Precisely. If the premium collapses, your stock value can plummet. There's this concept of gravity for a company's market-to-net asset value, the MNAV. It naturally tends towards one over the very long term. This means if a company just stopped its treasury operations, stopped growing, stopped innovating, its stock would likely tend to trade much closer to its net Bitcoin value, plus maybe some value for its operating business. So these companies need to continuously generate reasons for that premium through ongoing accretive accumulation, strategic financing, income generation, positive narratives to keep it elevated. If they don't, that premium can quickly erode, wiping out a significant portion of an investor's gains or amplifying their losses. It's a constant battle against market gravity.
Okay, so if you're evaluating these Bitcoin treasury companies, beyond just tracking the Bitcoin price itself, there are several key metrics you really need to monitor for their health, their performance. What's at the top of your list?
Number one, especially for Metaplanet, given their explicit focus, is BTC yield, that growth of Bitcoin per share. A consistent positive BTC yield indicates accretive capital raises. It means they're adding more Bitcoin per share than they're diluting through share issuance. This is the holy grail for shareholders in this model.
And a flat or negative yield is a big red flag.
A huge red flag. It would signal that their capital raising isn't efficiently translating into per share value. Maybe they're issuing shares too cheaply or their costs are too high. MicroStrategy also pursues positive BTC yield, showing similar discipline, but their public emphasis often includes that total Bitcoin stack size as well.
And naturally, the premium to NAV, or MNAV, which we just explored in depth, is another vital indicator to watch constantly.
Precisely. It's a direct measure of market sentiment and that speculative fervor. A healthy premium is sort of expected because of the operational alpha argument we discussed. But sharp compression signals waning confidence. It indicates the market is maybe starting to question the value of that alpha, or perhaps worried about future execution. You also need to track their progress on accumulation targets. Are they hitting their goals?
Right. Are they actually buying the Bitcoin they say they will?
Exactly. Assessing the pace and the cost of Bitcoin acquisitions against their stated goals, like Metaplanet's 30,000 BTC by year-end 2025, or MicroStrategy's huge capital raise targets. Missing these targets consistently could signal execution issues, or maybe changing market conditions that make their strategies less viable or more expensive.
For Metaplanet specifically, given their unique strategy with the options income, what other metrics become really important for understanding their financial health?
Yeah, for Metaplanet, the health of its Bitcoin income generation program is crucial. Specifically, the income generated from selling those put options. A significant decline in this revenue stream, maybe due to falling volatility or poor execution, would increase pressure on them to raise capital elsewhere, especially in a bear market. It makes them more reliant on potentially dilutive equity raises.
So that income stream is a key shock absorber for them.
It really is. Another unique and critical factor for Metaplanet is Japanese monetary policy. We touched on this. Any significant shift towards higher interest rates in Japan would fundamentally alter their cost of capital, eroding that key strategic advantage tied to Japan's long-standing ultra-low rate environment. Not an immediate threat, perhaps, but a long-term risk investors need to keep on their radar.
And for both companies, given their leverage strategies using debt, using high stock valuations to buy assets, their debt structure must be a major point of analysis.
Absolutely critical. For both, assessing their debt structure and refinancing risk is vital. You need to look closely at the terms of their debt. What are the interest rates? What are the maturity dates? In a bear market, refinancing or repaying that debt can become really problematic if stock prices fall sharply and investor appetite for new bond or equity issues evaporates. This could potentially force them into selling Bitcoin at low prices, which is the last thing they want to do.
Yeah, forced selling in a downturn is the nightmare scenario.
It is. Metaplanet's debt to Bitcoin NAV ratio was reported around 9%. They consider that high for themselves, wanting to keep leverage relatively controlled, but it's actually quite low compared to some other players, maybe some miners, who lever up much more aggressively. You also need to monitor their overall balance sheet health. Look at metrics like the equity-to-asset ratio, their cash balance, get a sense of their overall liquidity and financial position. Metaplanet's equity-to-asset ratio, for instance, was a healthy 62.3% at the end of FY 2024, indicating a pretty robust equity cushion at that time.
Okay. And finally,
Keep an eye on trading volume and liquidity. High volumes are essential for ensuring efficient capital raising through those share issuances, particularly for Metaplanet's warrants and MicroStrategy's ATMs. And maybe more qualitatively, management's commitment. Are they truly all in on this Treasury strategy? Companies perceived as being only half committed tend to be less rewarded by the market with that serious premium. It really seems to require unwavering conviction from the top.
Okay, that's a great checklist of metrics. Let's pivot now and consider how these companies might navigate different market cycles. A Bitcoin boom, a bust, or maybe just a sideways stale market. Expert in a Bitcoin boom, a raging bull market, how do Metaplanet and MicroStrategy really shine? Where do they outperform?
In a Bitcoin boom, Metaplanet seems exceptionally well-positioned to outperform, potentially even more than MicroStrategy on a percentage basis due to its model. Its leveraged nature, the high market liquidity, that potentially very high premium valuation, these allow for incredibly efficient capital raising and aggressive accumulation. It creates this powerful, self-reinforcing flywheel effect we talked about.
Right, the rising Bitcoin price lifts the stock, which allows cheaper capital raising.
Exactly. Rising stock price, cheaper capital via warrants, and maybe cheap debt, allows more Bitcoin buy, increases investor sentiment, pushes stock price higher, and repeat. This can create explosive growth potential, truly amplifying Bitcoin's gains for shareholders during a strong bull run.
And MicroStrategy, with its sheer scale, must also thrive in a bull market, right?
Yeah,
Just maybe through different mechanisms.
Absolutely. MicroStrategy also thrives. They leverage their immense scale and that diverse financing toolkit, convertible debt, preferred stock, the ATM, to raise truly massive amounts of capital for Bitcoin acquisition. And Michael Saylor's relentless advocacy, his global platform, further fuels investor interest and helps maintain or even expand the stock's premium during bull phases. The primary risk for both companies in a boom market, really, is overspeculation, getting ahead of themselves, and developing an excessively high, unsustainable premium to NAV.
Signs of frothiness.
Yeah, signs of froth. We often see indications of a late-stage bull market, like exploding leverage across the crypto ecosystem, futures, options, lending markets going wild. Often this happens alongside a relatively quiet underlying Bitcoin network, maybe fewer small retail transactions, suggesting a shift from organic accumulation to more speculative excess. That's when things can get dangerous.
Okay, now for the real stress test. What about a Bitcoin bust? A prolonged grinding bear market? How does Metaplanet, with its reliance on that low-cost capital and maintaining a high stock premium, fare in such a scenario? What are the vulnerabilities?
This is Metaplanet's primary existential risk, according to one analyst report we saw. A sustained downturn in Bitcoin prices, and consequently their stock price, would definitely expose vulnerabilities. Their debt risk becomes more apparent. If the stock price falls significantly, raising new equity via those moving strike warrants could become prohibitively dilutive, or maybe even impossible if investor enthusiasm just evaporates completely.
So their main engine for cheap equity capital could stall out.
It could, and this could force them into a very difficult choice. Either sell Bitcoin, which directly violates their core mission of accumulation and growth in BTC per share, or Try to roll over existing debt, potentially at much less favorable terms if interest rates have risen or credit markets are tight, which would significantly increase their ongoing cost of capital. Their option strategy also faces risk in a bear market. Premiums collected from selling put options would likely decline significantly, especially if volatility drops. And a sharp crash could actually force them to buy Bitcoin at strike prices that are suddenly way above the current market price, draining their cash reserves and crystallizing losses.
So the income stream could dry up or even become a liability.
Potentially, in a crash scenario. Metaplanet is described as being structured to survive a volatility shock, like a quick, sharp drop in recovery. But a prolonged bear market, surviving that without being forced to sell Bitcoin or enduring massive detrimental dilution, that's their core challenge. It's a real test of their balance sheet resilience and the long-term conviction of their investor base.
That sounds incredibly challenging for Metaplanet in a long bear market. How does MicroStrategy, on the other hand, appear to be positioned to weather such a storm, given their different capital structure and longer history?
MicroStrategy seems to have, perhaps, a more robust or at least more diversified plan for navigating bear markets. Michael Saylor has expressed confidence in handling downturns with their expanded toolbox of diverse securities, those different types of fixed income, the preferred stocks we discussed. These instruments appeal to different pools of capital. Some of those pools might be less sensitive to short-term Bitcoin price movements than common equity investors are. Think institutional bond buyers, income investors.
So they can tap different funding sources even when the stock market is weak.
That's the idea. They can potentially adjust their capital raising strategies to appeal to these various segments, even in distressed market environments. The goal is to take pressure off the common equity, MSTR, by offering these other instruments. This might help them avoid forced Bitcoin sales even if the common stock price drops dramatically. Their stated aim is to maintain a healthy, robust, pristine balance sheet to weather downturns. This focus likely became incredibly important after experiencing previous crypto winters.
Right, they've lived through major drawdowns before.
They have, and generally speaking, in a bad bear market, you often see the less committed companies, maybe including some Bitcoin miners who inherently incinerate capital, just running their operations, being forced to puke out their coins at a low price. They sell their Bitcoin treasury just to protect their share price or simply to survive, especially if they lack that strong CEO ownership commitment and long-term vision you see with someone like Saylor.
Okay, so different resilience profiles in a downturn. What about the third scenario? A Bitcoin stale market, a sideways grind. This is a situation where prices are flat or just range-bound without significant upward or downward momentum for a long time. Does one company have a clear advantage here?
This is arguably where Metaplanet's Bitcoin income generation program provides a really crucial advantage. It allows them to constantly earn money from Bitcoin's inherent volatility. Even if the price itself is just chopping around sideways, going nowhere fast, they're still selling those put options, collecting premiums as long as there's some volatility.
So even if Bitcoin isn't going up, they have an income stream.
Exactly. This provides vital operational cash flow. It reduces their reliance on dilutive financing during periods when market enthusiasm for new equity raises might be low because the Bitcoin price isn't doing anything exciting. This small thing, as one analyst described the options program, gives them so much better staying power in a non-trending market. It provides a yield component that purely holding Bitcoin or relying solely on capital raises for accumulation might not offer.
So a built-in revenue stream that insulates them somewhat from stagnating price action. MicroStrategy, then, would be less equipped for a long, stale market, given its primary focus on accumulation via capital raises.
That's generally correct, at least based on their public strategy. MicroStrategy has less explicit focus on generating income directly from volatility itself. Their primary engine remains capital raises for accumulation. In a truly stale, low volatility, sideways market, their ability to continue raising capital on favorable terms might be challenged. If the Bitcoin growth narrative stalls, if investor excitement wanes, it could impact their accumulation pace. However, their diversified fixed income offerings, the bonds and preferreds, could still find demand from investors seeking yield or relative stability, even if the common stock struggles to maintain its premium. So while their accumulation might slow, their diversified financing toolkit still gives them resilience, just maybe less of an active income advantage in that specific scenario compared to Metaplanet.
Okay, fascinating comparison across the market cycles. Let's zoom out a bit now and consider the broader market context and what this all means for you, the investor. Again, remembering this is purely for educational purposes. The current Bitcoin cycle is often described as weird.
Yeah.
What makes this cycle so peculiar compared to previous ones?
It's certainly different. It feels peculiar. This current Bitcoin cycle is weird mainly because it's fundamentally much larger in terms of institutional participation than previous cycles. The sheer scale of capital flowing in, especially with the launch of the spot ETFs in the US, combined with the immense market cap of entities like MicroStrategy and Metaplanet themselves. Their combined Bitcoin-related market value now likely exceeds the entire Bitcoin market cap from the peak of, say, 2017.
Wow, the scale is just completely different.
Completely different scale. Yet, despite this massive influx of traditional finance, capital, and structure, it still exhibits some behaviors that feel uncannily similar to earlier, more retail-driven cycles. On-chain metrics still seem relevant, sentiment shifts still happen rapidly. There's this constant push and pull between mature institutional adoption and the classic, almost primal Bitcoin market dynamics playing out.
And what about those on-chain dynamics? Are we seeing any shifts in how Bitcoin is being transacted or held that tell us something interesting about this weird cycle?
Well, one key dynamic that some analysts have pointed out, maybe since around April 2025 or so, is a subtle but potentially significant shift. It seems less like a purely spot-driven market and more influenced by futures trading and leverage. You can see periods where overall transaction value is incredibly high, but the actual on-chain blocks might appear almost empty, dominated by a few very large transactions rather than lots of small ones.
So less retail activity visible on-chain.
Possibly. It raises questions about how the ETFs affect the interpretation of on-chain data because they bundle up lots of investor demand into fewer, larger transactions. But core on-chain metrics still seem to offer valuable signals about sentiment. Things like the percentage of coins held in profit or loss, the age of coins being moved, hodl waves, these still seem relevant. Interestingly, this recent rally phase has seen some older coins, specifically those held for 3 to 5 years, starting to distribute, move on to exchanges for the first time in this cycle. That might indicate some profit taking from long-term holders finally happening.
Interesting. What about Bitcoin versus altcoins?
Yes, Bitcoin dominance, that's been a huge theme. Bitcoin dominance has been in what looks like a 3.6-year unrelenting uptrend. It's been relentlessly outperforming most altcoins, many of which have seen just perpetual bleeding against Bitcoin. This really suggests a powerful, almost unwavering conviction among investors that Bitcoin is and will remain the primary asset in this space. Maybe a flight to quality or just a realization that the Bitcoin thesis is the clearest.
Okay, looking at the broader competition in this Bitcoin treasury space, you mentioned earlier we're seeing many new companies popping up like mushrooms, all eager to jump on the Bitcoin bandwagon. But you also said many are half in and underperforming. What really separates the successful ones like Metaplanet and MicroStrategy from the rest of the pack?
It really seems to boil down to a go hard or go home mentality, total commitment. Many of these newer companies, they might be genuinely interested, but they are often perceived as half in, meaning their Bitcoin treasury might be a secondary focus, maybe a small part of their overall balance sheet, or perhaps they lack the aggressive accumulation strategy, the diverse financing toolkit, or that focus on operational alpha needed to consistently grow Bitcoin per share in an accretive way. They might buy some Bitcoin, put out a press release, but they often underperform just holding Bitcoin directly in the long run because they don't generate that premium or execute efficiently.
So commitment is key to getting the market's attention and that premium valuation.
It seems that way. Only companies that appear fully committed to the treasury strategy, willing to dedicate their balance sheet, management focus, and expertise to it, seem to be seriously rewarded with a sustained premium by the market. MicroStrategy and Metaplanet are currently seen as the two that have really stood the test so far. MicroStrategy is often called the Bitcoin of treasury companies for its pioneering role and just sheer scale.
So do you see room for a growing ecosystem of these treasury companies? Or will it likely remain a very concentrated space with just a few major players?
That's a really interesting question for the future. Could there be room for a duopoly, maybe like a Microsoft and Apple dynamic, perhaps in the US market between MicroStrategy and maybe another strong contender eventually? Or perhaps a handful more internationally, but probably not 1,000 or 10,000 of these companies. That seems unlikely. Too much saturation would probably lead to investor fatigue. People would just give up trying to pick winners.
And just buy a Bitcoin ETF instead.
Exactly. If there are too many options that all look similar, investors might just shift towards index-like investment, like a spot Bitcoin ETF, rather than trying to analyze the operational alpha of dozens of different Treasury companies. So for investors looking at the space now, it really seems to be about identifying those companies with genuine staying power, especially the ability to survive and even thrive during downturns, because that's when the true commitment to the Bitcoin Treasury strategy is really tested.
Okay, so when it comes to thinking about optimal holding strategies for you, the investor, again, not financial advice, it really seems to come down to your individual risk appetite first and foremost. An investment in Metaplanet, for instance, sounds like a high-conviction bet on the long-term appreciation of Bitcoin, amplified by financial leverage and the skill of its management team. Is it fair to call it a leveraged long-duration call option on the future of Bitcoin, and who is that best suited for?
I think that's a very apt description. It's fundamentally a leveraged long-duration call option on the future of Bitcoin. This means it's likely best suited for investors with a high risk tolerance who have a very strong conviction in Bitcoin's long-term appreciation potential and, importantly, are comfortable with significantly amplified volatility compared to just holding Bitcoin. You're not just betting on Bitcoin, you're betting heavily on the management team's ability to execute a complex strategy, navigate tricky capital markets, generate that options income consistently, and ultimately deliver that operational alpha. It's for those who specifically want to supercharge their Bitcoin exposure through a public equity vehicle and accept the added risk that come with it.
So how might an investor think about diversifying their approach to Bitcoin exposure, considering these companies versus direct ownership? What are the trade-offs?
Well, for those prioritizing really aggressive growth and that per-share accumulation metric, BTC yield, especially if they are sensitive to Japanese market dynamics and the tax advantages there, Metaplanet's model might look particularly compelling. For those perhaps seeking exposure to a larger, more established player, one with a much broader range of financing instruments and a clearer focus on just accumulating the largest absolute amount of Bitcoin, MicroStrategy might be preferred. It's seen as maybe a more mature, diversified approach in some ways.
But direct ownership is always an option too.
Absolutely. And it's crucial to remember Bitcoin's inherent volatility even without the company layer. Some investors might simply opt for direct Bitcoin ownership to avoid all company-specific risks management, execution risk, strategy risk, and especially that danger of premium compression we talked about earlier. Direct ownership offers simplicity. It removes that entire layer of corporate complexity and counterparty risk. You just own the asset.
Your market cycle positioning, or your outlook on the market cycle, also seems to play a significant role in which vehicle might be optimal at any given time.
Precisely. In strong bull markets, both stocks, Metaplanet and MicroStrategy, may offer amplified returns due to their leveraged nature and the market's enthusiasm potentially boosting their premiums. In sideways, choppy markets, Metaplanet's income generation from its options program could offer a yield component or cash flow buffer that MicroStrategy doesn't explicitly focus on providing. That could be attractive during stagnant periods. And in bear markets, the focus shifts entirely to survival and resilience. Assessing the company's toolbox to withstand deep drawdowns becomes critical. You'd look at MicroStrategy's varied securities and multifaceted capital raising approach versus Metaplanet's options income stream and their ability to issue shares effectively even with a lower premium. It's about understanding which vehicle is built better for which type of road condition and which risks you're more comfortable with.
And finally, timing seems critical, especially with that premium dynamic. Buying high can really hurt.
Indeed. Timing is incredibly difficult, but understanding the premium is key. Buying when the premium to NAV is excessively high can lead to significant losses, even if the company successfully increases its Bitcoin holdings per share. That premium compression can wipe out the gains from the underlying asset growth. So the advice seems to be, don't just chase momentum. Don't go feeling FOMO, fear of missing out, on newly listed, highly valued treasury companies just because they're hitting the public markets with a lot of hype. That companies with demonstrated staying power through different market cycles, those showing consistent operational alpha and maintaining a robust balance sheet, those are probably the ones worth studying more closely. It really requires diligent research, not just chasing headlines or high premiums. So we've really navigated the intricate strategies of Metaplanet and MicroStrategy today. Two truly fascinating examples of how public companies are engaging deeply with Bitcoin, understanding their unique approaches, their sophisticated financial tools, and yeah, their vulnerabilities in different market environments is absolutely key if you're trying to make informed decisions in this rapidly evolving space.
And as we look to the future, this really prompts a fascinating question for me. If Bitcoin continues on this weird cycle, constantly reinventing narratives and defying expectations, how might these companies, Metaplanet and MicroStrategy, need to adapt their strategies? How do they maintain their competitive edge, especially as institutional adoption continues to evolve and maybe more competitors try to enter? What new financial instruments might emerge? And how might all this reshape the traditional finance landscape even further?
That's the million-dollar question, isn't it? This deep dive really highlights that while Bitcoin itself might be elegantly simple in its core design, the financial engineering being built around it is anything but simple. It's complex, it's evolving. The success, or indeed the challenges faced by these pioneering companies, offers a compelling, real-time case study for the entire financial world. It really shows the ingenuity that gets applied when a disruptive new asset class meets traditional capital markets and innovative management teams.
So what does this all mean for you listening in? It means you have more nuanced ways than ever to gain exposure to Bitcoin, if that's something you're considering. Each approach, direct ownership, Metaplanet stock, MicroStrategy stock, even ETFs, comes with its own distinct set of advantages and, importantly, risks. The more you understand the underlying mechanics of each, the better equipped you'll be to navigate this exciting but undoubtedly volatile space.
And just one last time, we absolutely must emphasize, this entire deep dive was purely for educational purposes. It should not be considered financial advice in any way. Please do your own research and consult with qualified professionals.
Absolutely. Thank you so much for joining us on this deep dive. Stay curious, stay informed, keep digging deeper, and we'll catch you next time for another fascinating exploration.